Welcome back. I'm talking today about one of the most powerful and most underused tools in real estate investing, the 1031 exchange. If you've been in real estate for any length of time, you've probably heard the term, but a lot of investors have only surface level understanding of how they actually work. And that surface level understanding costs them money. Either they don't use an exchange when they should, they make a procedural mistake that blows the whole thing up, or they end up in a replacement property that underperforms because they were rushed and they didn't know their options. And on a side note, one of the best things you can do when you're thinking about doing a 1031 exchange, email your CPA, say, hey, I'm thinking of selling this property. I'll probably get X price for it. What are my tax consequences if I don't do an exchange? And sometimes you're pleasantly surprised and it keeps you from rushing into a property that you wouldn't have otherwise done. But we're here to talk about good properties and good options, and I'm confident you're going to like what we have to offer. So we're going to go deeper. We're going to cover how these traditional 1031 exchanges work, and we're going to talk about the less commonly known structure called the improvement exchange and give you that real framework for how to think about it when this comes up in your life, because it's going to if you're a real estate investor. So a 1031 exchange is named after Section 1031 of the Internal Revenue Code. It allows an investor to sell an investment property and defer the capital gains tax on that sale, as long as they reinvest the proceeds into a like-kind replacement property. Like-kind sounds like it means like you have to swap the exact same type of property. A house for a house, like a warehouse for a warehouse. That's actually a misconception. So the IRS defines like-kind as quite broad, or their definition of it is quite broad. You can sell a single-family rental and replace it with a commercial building. You can sell raw land and replace it with a rental home. The requirement is that both properties are held for investment or business purposes, not that they look the same. What you cannot do is exchange your primary residence or a property you bought to flip. Both the property you're selling and the property you're buying need to be investment or business use assets. So here's the part that trips people up, the timelines. Once your sale closes, the clock starts immediately. You have 45 days to formally identify your replacement property in writing. Not 45 days to find something interesting, 45 days to submit a written identification to your qualified intermediary. That's the third party who holds your exchange funds through the process. Note, that doesn't mean you can't identify the property before, right? Talk to your CPA obviously on that, but you can identify it before the 45-day clock starts ticking too. So if you miss that deadline by 1 day, the exchange fails. From there, you've got 180 days total from the sale date to close on your replacement property. And that 45-day deadline falls within the 180 window. It's not in addition to it. So sold it, I have 45 days, but the 180 starts ticking from the day you sold it as well. One more important rule, you can't touch the money, right? Can't get your dirty mitts on your own money. Those have to go directly to a qualified intermediary. You never take possession of those funds. You don't touch them. The moment they hit your personal account, the exchange is disqualified. So that's why choosing a qualified intermediary you trust is so important. Why working with an experienced one from the start protects you. There's some hokey intermediaries out there. So the financial logic here is compelling. Let's say you bought a property years ago for $150,000. Today it's worth $400,000. If you sell without an exchange, you're looking at capital gains tax on $250,000 of gain. So that's $50,000 or more out of your pocket, depending on your tax situation, before you even factor in depreciation recapture. So if you've done cost segregation, that's even worse. You're going to have to recapture that. So a property or a properly, executed exchange, it lets you roll that entire $400,000 into your next investment so you can keep compounding. So over multiple exchanges over a career, that deferral compounds and it turns into a lot of money, right? Because once again, on those gains, the IRS is looking to take a lot, especially if you're doing the depreciation. So if you can just keep pushing that off and pushing that off, it's very, very powerful. So we covered the basics. Let me take a minute on where investors make some mistakes. The mechanics are pretty simple, but the execution has some landmines. The first is waiting too long to start looking for the replacement property. I see this a lot. An investor closes their sale, they think they've got plenty of time, and then week 4 arrives and they're scrambling. We get those calls. The 45-day window sounds reasonable until you're actually in it trying to evaluate properties and run numbers and do due diligence and make decisions. Investors who start identifying potential replacements before their sale closes, or I'll add, even before they put their property on the market, they're in a lot different position than those who start after. The second mistake people make is over-identifying. The IRS lets you identify up to 3 properties without restriction, or more than 3 if the combined value doesn't exceed 200% of your sold property's value. So some investors think loading up as long as it's a safety net, but if you've identified 15 properties and haven't done real due diligence on any of them, you haven't bought yourself any time. You just created a bunch of confusion. So the whole point is you can't identify all the properties in this town, right? There's some strict rules there. The third mistake is, this is pretty painful, is underbuying. So to fully defer those gains, you need to replace your debt and equity. So if you sell a $400,000 property with a $100,000 mortgage, you need to purchase replacement property worth at least $400,000 and take on at least $100,000 in new debt or add additional cash, right? In real estate, we call that like sources and uses, like what is the money, the capital stack that we're going to use here? You have to replace it. So if you trade down in value, you pay tax on that difference, and it's called boot. That's a situation you'll run past your CPA too, because sometimes that might be better than the alternative, right? Sometimes it's the lesser of two evils. So investors oftentimes don't realize that until after the fact. So the fourth mistake is treating the 1031 exchange as the only consideration in picking a replacement property. Yeah, you want to complete the exchange, but you're also going to own this asset for years, hopefully decades. So the tax deferral is the vehicle, the property itself is the destination, right? And investors all the time, they get so freaked out about paying a little bit of money to Uncle Sam that they rush into something that they otherwise wouldn't have done. And we certainly want to avoid that. So let's talk a little bit about a different niche, the improvement exchange. Some of the properties we do at Peak Group are sold pre-construction, where you close on land with a construction loan in place, and you hire us as the GC, and you build the property. It's a little more advanced. That improvement exchange, I've heard it sometimes called a construction exchange or a build-to-suit exchange too. It's a structure that most investors haven't heard of, but it's pretty powerful, and it's something we do a lot, like I said. Here's the problem it solves. In a standard 1031, you've got to identify and close on an existing property. But what if you want to sell your property, take those proceeds and put them into something new, a new construction deal, and it needs a lot of renovation, or you need to build exactly what you want? In a standard exchange, you can't do that. You have to close on the land or the existing structure, and any improvements you make after closing with your own money, they don't count towards your exchange value. An improvement exchange changes that. In a properly structured improvement exchange, your QI, or your qualified intermediary, actually holds title to the replacement property during the exchange period, during that 180. And so while construction improvements are completed, and because the QI holds title, the improvements made during that period count as a part of the exchange value, meaning you can direct a larger portion of your funds into a new, significantly improved asset. So think about what that enables. You sell an older, underperforming property. Instead of hunting for a comparable existing one, you identify a new build opportunity, right? Like a home or a duplex or flex space, and you structure the exchange so that the value being built during it counts towards your replacement. You end up with a brand new asset, full depreciation schedule reset, and a property built to perform from day one, rather than one that you inherited somebody else that might have a bunch of deferred maintenance on it. So the timelines in an improvement exchange follow the same rules: 45 days to identify, 180 days to close, and all improvements, they've got to be substantially complete by the 180-day mark. So basically, they take your land value, they add up all the construction that happened up to the 180th day, and then boom, they deed the property into your name. And that's what you can prove that you owned in the event that you were ever audited. So that timeline has to be realistic and well managed. It's one of the reasons we're really careful about which projects we structure this way, because if the building takes longer than expected, you could have boot, you could have tax owing. So having an in-house construction team that controls the timeline is a big advantage for you here. Those improvement exchanges, they require tight coordination between the investor, the intermediary, the builder, the attorney, right? All these parties are aligned and experienced. It works well. When we're not, it falls apart. So we spend a lot of time working with investors on timelines of new builds that we're going to start this way, when they're going to sell their property. It's something that we can help with, and we're generally pretty good at it. We've done a lot of these. So for the right investor, the right project, it's a good tool. It opens options that most people didn't really know that they had in going from an old tired property into a brand new build. So let's think strategically. Let's zoom out. Investors who use a 1031 exchange most effectively aren't just thinking about deferring tax on a single sale. They're thinking about what kind of portfolio they want to own over the next 10 or 20 years or more, and using exchanges as a deliberate mechanism to get there. Because when you can take the tax man out of the equation, you compound so much faster. That's a big check you have to write otherwise, and it really slows you down. So maybe you own a property that's appreciated a lot, doesn't cash flow a lot anymore, values have gone up, but rents haven't kept pace, and that return on your equity is mediocre. You're sitting on that great gain, but the asset's no longer performing like a great investment. This exchange lets you take that appreciated equity and redeploy it into something that actually earns, that new construction rental in a high growth market, right? And what I love about it too is now you've got more depreciation. Not only are you not having to pay back the old depreciation, you just reset the clock. You've got more you can take to lower your taxes even more. It's not just a tax deferral. It's a big time portfolio upgrade and the best way that I know of to handle taxes. It just compounds. If you exchange into that property, the gain grows and grows and multiplies on top of itself. So we love working with 1031 exchange investors. Reach out to us if you're considering one, and we can let you know what we have in the pipeline, whether it's properties that are already completed or maybe before, properties that are pre-construction, and we can help you plan. So thanks again for listening. We'll catch you on the next episode.